Hey everyone, welcome back to the channel. Are you ready to learn the tips to successful investing? So let's dive right in. First off, my name is Isaac Jonas and I'm an economist with over 5 years experience trading and investing in the Canadian and the USA stock exchanges, but also the Zimbabwean stock exchange. Now, over the years, even though I academically learn about the markets, and also I've been reading a lot of books and still learn every day, I have realized that it is also important to constantly be humble and also to learn every day, because things change in the market. So now I'm going to first off talk about the common pitfalls that most investors or beginner investors, even professional investors, face. Because if you can manage those mistakes, then you can amplify on the other good traits that can make you a successful investor. From chasing hot trends like meme stocks to letting your emotions get the best out of you, those mistakes can cost you dearly. So moving on to the do's and don'ts of investing. The one key principle that I've learned is that diversification is very key, right? By spreading your investments across different sectors, it means that if one sector is not doing well, right, the other sector can also give you the other return. I am talking about, in my case, I like to invest in exchange traded funds that track the index funds. Basically, for example, the S&P 500, the Nasdaq, the Dow Jones Index. These are major indices in the US that are constituted by companies that come from different sectors. And what happens is that it's very hard to predict which sectors are going to do better tomorrow or in the future. For example, right now the semiconductor sector has been doing really well. You have companies like Nvidia, AMD, they are doing really well. But it's not guaranteed that they are going to continue doing that. But if you invest, let's say, in exchange traded funds that mimic the S&P 500, that is the top 500 companies in the US, what that means is that there are different sectors like technology, consumables, energy sector. So when the other sector is not doing well, the other one can do that. And more importantly, the data shows that 94% of all professional investors over the past couple of years in the US, they have failed to beat the S&P 500. There are only a few people, like exceptional people like Warren Buffett and other notable investors, right, who are really successful in that game, right? Peter Lynch, for example, he returned about 29% consistently. But even though it was a very volatile portfolio, in the sense that some people lost money when it went up and went down, people panicked. And I will get down to the point of emotions right after explaining this. So I think at the end of the day, in my case, this is not investment advice. I've learned that in as much as I understand certain sectors and certain businesses, the data shows that it is very hard, exceptionally hard, to beat the S&P 500. So I want to invest in most of my money in that sector. Now, I want to think long term all the time when I'm investing, right? In so doing, what that means is even if there are short-term fluctuations, I can actually be actively buying only the securities that I understand. For example, if the S&P 500 exchange traded funds drop by 10%, 20%, I will be buying as long as the fundamental story has not changed. So this is very important. Now, I also like to have a hedged portfolio at all times, because the market does not go up all the time. Sometimes it goes up, sometimes it goes down. But over the long term, if I look at the S&P 500, the Nasdaq, the Dow Jones, it has historically gone up. Even if I look at the Toronto Stock Exchange, the indices there, they actually have been going up. But you see that in countries like Japan, there were years when the major indices, they were dropping, right now it has started to go up. But what that does is that if you have a portfolio that is not positively correlated with equities, for example, if I have gold, exchange traded funds, or even gold itself, or I have cash or fixed income securities, like just putting money in a high yielding fund that can give me maybe 6%. In Canada, it's available. Some banks are giving that amount that is above inflation of 3%. What that means is that even if the market drops by 30%, 40%, and if I have an emergency fund, at that point it would be a wonderful time to get in and make even more money in the future, right? Sometimes the market can go down 2, 3, 4 years, right? So if you don't have an emergency fund, more likely you might be forced to sell at the bottom. That's how people lose money again and again. Now the fourth point, is controlling emotions. I was talking to my friend today. Actually, he was calling me to say, look, you have been telling me about this, and sometimes I couldn't just help. He woke up today, I'm recording on the 3rd of June, and GameStop, it's a meme stock, it was up pre-market, and what he did is he bought 200 shares with the expectation that it was going to go up in his trading plan. But what happened is that it went down and is down, and most likely it might actually continue to go down. So at the end of the day, investing is very boring in the sense that most of the time when I'm investing in my portfolio, I'm not doing much other than reading, analyzing some businesses, and that's when a lot of money is made. When you are patient, when you wait, it means that when the opportunity comes, a lot of people, in some cases, they may just panic, right? And if you have done your homework, that's a good time to actually get in, right? Think of it this way. You are at a cinema, and then one person starts to get out of the cinema room, and then the next person follows suit. Most likely people might become suspicious and start to go out, and there might be a stampede. But if you look closely, sometimes maybe there might not be something, but sometimes there might be something. So what happens is the big hedge funds, when they get out, they have a lot of money that is invested, for example, so it can affect the price, right? But sometimes they may be getting out for other reasons. There are quite a number of businesses that are really fundamentally strong, but sometimes maybe big institutions, what they do, my understanding is that sometimes they have like quarterly benchmarks to say you have to beat this or to get this return. So maybe they might be moving their money to another sector, or maybe going to cash, and it may not necessarily have to do with the fundamentals of that business. So the long and short of it, in conclusion, is that it is very, very important to do your own research. If you don't understand, it is very important to consult experts like tax advisors, or go to financial advisors and have those questions and ask, and make sure that you understand how much they are charging in terms of fees. In Canada, I believe it's about 2% of the money that is charged off for the fees. So those things, they can add up. But in my case, I do my own investing because I am passionate about it, and I like to educate myself. It's not for everyone. So at the end of the day, you have to choose what works for you, and also protect your money, because your money is your money. So in conclusion, thank you so much for watching my videos. If you haven't checked out some of my videos, please make sure you do so that you can get some more interesting insights about personal finance and investing. And let me know what you think about the do's and don'ts of investing, and some of the mistakes that we have made in the comments below, so that we can also learn from each other. May the markets be with you. Have a wonderful day.